3.2 years. That is the exact lifespan of an AI server before it becomes an expensive paperweight. While everyday investors are rushing into AI data center stocks thinking they are buying safe digital real estate, they are actually stepping onto a fast-moving treadmill. Standard advice tells you that because AI needs data centers, you should buy the landlords. In reality, this mistake traps your money in a multi-billion-dollar loop of replacing broken hardware. By the end of this video, I will show you the exact timeline of this spending cliff and the single math formula that separates a true winner from a total trap. To keep this completely fair and remove the hype, let's look at two investors, Alex and Leo. Both have $50,000 to invest in the AI boom. Alex buys a highly praised, pure-play AI data center stock. Leo puts his $50,000 into a boring, unhyped energy grid supplier. Alex feels great because his stock is all over the news and jumps 20% in months. Leo's investment looks completely flat and invisible. But underneath the surface, the math rules governing their money are moving in opposite directions. To see the truth, we have to strip away the word AI entirely. A data center is not a magical tech asset. At its core, it is just a specialized warehouse that rents out space, cooling systems, and massive amounts of electrical power to third parties. That is the raw machine underneath the hype. The big problem is that Wall Street purposely groups these companies into safe buckets like real estate or infrastructure. They do this to make everyday investors feel secure, as if they are buying a steady apartment building or a toll road. But this is a massive industry blind spot. In the past, legacy data centers hosted older servers that easily lasted 10 to 15 years. They were stable, long-term investments. AI data centers are completely different. They host high-density chips that run incredibly hot and age at an alarming speed. Because of this intense heat and rapid wear, these facilities require complete system overhauls every few years just to keep running. You are not buying a permanent piece of land. You are funding a building that constantly eats its own profits to survive. Let's map out exactly what happens during the first 3 years of this timeline. At first, it looks like Alex made the ultimate winning move. His AI data center company reports massive, surging revenues because major tech giants are rushing to rent out every square inch of available space. The financial news praises the stock, the share price climbs higher, and Alex happily brags about his quick portfolio gains at dinner parties. To everyone around him, he looks like a genius investor. Meanwhile, Leo's boring energy grid investment looks completely dead. This is the ultimate social proof trap. Leo has no exciting gains to talk about, and his portfolio looks totally flat and invisible on his screen. It feels like he completely missed the biggest tech boom of the decade. But right around year 3, the silent physics of math catch up to the hype. Suddenly, the data center's very first batch of expensive AI hardware hits peak obsolescence. The fast, shiny chips they bought just 36 months ago are now too slow and inefficient to compete. Without warning, the landlord is forced to face a massive, unpredicted financial wall just to keep their renters from leaving. This is where popular internet influencers get it completely wrong, because they only look at gross profit margins. They see huge checks coming in and assume the business is a gold mine, but they are completely ignoring the business's silent partner, capital expenditure, or CapEx for short. CapEx is simply the actual cash a company must constantly pour back into its buildings and equipment just to stay open. When you look past the basic napkin math, the hidden friction begins to drain the company dry. First, there is the astronomical cost of specialized liquid cooling systems breaking down under the intense, constant heat of AI chips. These are not standard air conditioners. They are complex, expensive setups that wear out fast. Second, local power grids are starting to cap energy allocations. This means the data center cannot grow because the city literally will not give them any more electricity. Finally, there is the biggest threat of all, customer loss. These data centers rely on a few massive tech giants to rent their space. The moment a giant client decides to build its own private facility instead of renewing an expensive lease, the data center landlord takes a massive financial hit. They are left with an empty, incredibly expensive warehouse and no one else to pay the bills. To protect your money from this trap, you need a definitive line in the sand. This is a simple calculation called the capex to operating cash flow ratio. Think of it as a strict mathematical health test that separates real wealth builders from dangerous traps. The exact boundary you need to watch out for is 35%. This is where the basic rules of financial physics take over. When a data center company is forced to spend more than 35% of its incoming cash just to maintain its buildings and replace its dying tech infrastructure, it crosses the line. Once a business goes above this threshold, it loses the ability to compound wealth for its shareholders. It does not matter how high its stock price flies on the news or how many contracts it signs. Above this line, the company is trapped on a treadmill, running as fast as it can and spending all its profits just to stay in the exact same place. Now, let's flip the script and see what happens when you keep your money safely below that crossover line. Instead of betting on the flashy landlords who have to replace their equipment every few years, you shift your cash to the steady bottlenecks. These are the boring but necessary companies that supply the raw materials everyone is fighting over, like copper, heavy-duty electrical transformers, and long-term power contracts. This simple optimization changes everything. By investing in the basic infrastructure, you still catch all the massive financial upside of the AI boom, but you completely avoid the dangerous 3-year hardware replacement trap. Tech giants might switch landlords, and servers will definitely burn out, but every single data center on Earth will always need copper wires and electricity to survive. This smart shift acts as a built-in defense mechanism for your portfolio. It protects your wealth from steep drops and easily beats the shaky, unpredictable returns of the data center stocks over the long haul. To understand how the game is truly played, we have to look at what the big institutional players and smart money are doing. Wealthy fund managers are not chasing overvalued public data center stocks at crazy prices. They know the math doesn't work out when you pay massive premiums for a business with high upkeep costs. Instead, they use a completely different insider playbook. They look for old, struggling power plants that own valuable connections to the energy grid. They buy these distressed assets cheap, lock down long-term power agreements for pennies, and set up the basic infrastructure. Then, right when the massive hardware replacement costs are about to peak and drain the business, they package everything up into a shiny new stock and sell it to everyday retail investors through the public markets. They pocket the guaranteed profit and leave regular investors holding the bag right when the expensive upkeep phase begins. Now let's fast forward the timeline 20 years into the future to see the final scoreboard. Over 2 decades, Alex's data center company ran into a major problem. It simply did not have enough cash to buy new chips every few years. To pay for those massive infrastructure rebuilds, the company had to dilute its shares 4 separate times, which cut into Alex's ownership and shrank his returns. Meanwhile, Leo's boring investment compounded cleanly year after year without any friction or share dilution. When you look at the final numbers, the ultimate dollar gap between their portfolios is staggering. Leo ended up with a massive fortune, while Alex's gains were completely wiped out by the constant cost of replacing old hardware. Leo did not win because he picked a flashy trend or guessed the future. He won simply because he kept his costs low and minimized capital friction right from the start. To protect your money right now, you need to run a quick 3-step audit on your portfolio. First, open up the Investor Relations webpage for any data center stock you currently own and calculate its capex to free cash flow ratio. This tells you exactly how much money is flying out the window just to keep the lights on. Second, check the customer concentration risk to see who is actually paying them. If just one single giant client makes up more than 20% of their total incoming revenue, you need to run away fast. Third, stop looking at shiny percentage growth targets and convert those numbers into raw dollar replacement costs to see the real price tag. Block out the loud market noise, focus on the quiet math, and protect your capital.